Lots of our investor clients at Grafton Funding follow the BRRRR strategy. And at the Loan Broker Academy, we talk with our students a lot about the BRRRR strategy because it's really important that loan brokers understand how it works and what makes a BRRRR property a good or a bad investment for their borrowers. But what exactly is the BRRRR strategy, and what are the pros and the cons that both loan brokers and investors need to be aware of? Well, in this video, that's what we're going to break down. We're going to talk about the strategy, how it works, and what are the things that both loan brokers and investors need to watch out for. So BRRRR stands for buy, rehab, rent, refinance, repeat. And it's a great way for real estate investors to get monthly cash flow and to grow their real estate portfolio without having too much of their cash tied up long-term in a property. So this is how it works. So an investor will buy a distressed property and rehab it using either cash, a hard money loan, or a home equity line of credit. Then instead of the traditional fix and flip model where they're selling it for a profit, they keep it as a long-term rental. So they put a tenant into it. They then refinance to cover the cost of the initial purchase price and the rehab costs. And then they repeat the process all over again by starting again with the new property. Now, as with all investments, the success or the failure of this strategy is all about the math. It all depends on the numbers. Most long-term lenders, whether you're talking about a conventional bank or a DSCR lender, will do the refinance, the cash out refinance, at a max of 75% of the appraised value. Some lenders that we work with will go to 80%, but most is 75%. So for an investor to cover the purchase price, the rehab cost, any financing costs if they got an initial loan, and to get their cash back, their down payment and their closing costs and all that back, they need to have added some good equity to the property. So let's look at an example. Okay, so let's say an investor is buying a distressed property and they're buying it under value for $200,000. Okay, so their purchase is $200,000. And let's say their rehab costs are going to be $50,000. So their total cost is $250,000. Okay, so let's say they're going to get a hard money loan for this. Okay, so they're going to get a hard money loan at 90% LTV on the purchase price and 100% of the rehab costs. Okay, so this is their loan. So they're going to get 180, so that's 90% of the purchase price, plus they're going to get 50 for rehab. So their hard money loan is going to be 230,000. Their down payment then is going to be 20,000. So their down payment is 20. Okay, so let's just assume that on the initial purchase, they've closing costs. So like prepaid insurance, title fees, attorney fees, maybe origination fees. Let's just assume their closing costs on that purchase were $7,500. Okay. So closing costs are $7,500. And let's just assume their carrying costs. Carry costs are another $7,500. So interest on the loan, utilities, all that kind of stuff. So another $7,500. So between the down payment, the closing costs, and the carrying costs, that's cash out of pocket of $35,000 that they're going to need to do this. Okay, so the loan is going to be for $230,000, and they're spending $35,000 cash out of pocket. Now, when they finish the rehab and they go to do the refinance, and we get an appraisal, the appraisal comes back with a new value of $350,000. Okay, so now we've got, we'll say the ARV, we'll call it after repair value, is going to be $350,000. That's our new appraised value. Okay, so they've added $150,000 of equity to the property because they bought it for $200,000, but they bought it under value, remember. So they bought it for $200,000, it's now worth $350,000. They spent $50,000 on rehab. So they've added $100,000 in equity compared to when they bought it by doing $50,000 of rehab. Now their refinance loan is 75% of the appraised value. So we're going to say 75% of appraised value. So the refinance loan is $262,500 is their new loan. And that means their equity in the property is $87,500. So the new loan is $262,500 and they have equity of $87,500. Now let's just say that their closing costs on the new loan, the refinance, are also $7,500. Probably wouldn't be as high, but let's just say that their new closing is $7,500. So if they have a loan of $262,500 and we take off that the hard money loan that has to be repaid of $230, and we take off the $7,500 in costs to do the refinance, then that leaves $25,000 cash that's going back into the borrower's pocket when they do the refinance, the cash out refi. So they're getting $25,000 back. Now, the numbers that we initially did, they paid $35,000 out of pocket, and they've got $25,000 back now in the refinance. So that means by the time they're finished this BRRRR, they now own a property that's worth $350,000. We're assuming it's cash flowing, because otherwise, why would they do this in the first place? And also, it wouldn't have qualified for the DSCR refinance. So let's assume it's cash flowing with rent. But they own a property that's worth $350,000 that's cash flowing with rent, $87,500 equity in the property, and it's only cost them $10,000. So $35,000 in, $25,000 out. It's only cost them $10,000 cash out of their own pocket to do this. So if they had just gone straight off the bat to buy a turnkey rental property worth $350,000, they would have had to put down 20% plus closing costs. That's called 25%. So they would have been putting down roughly about $90,000 to get that property. Now they've put down $10,000 cash out of their own pocket, and they've got a property with $87,500 equity in it, which is cash flowing. Okay, so now that we know how a BRRRR strategy works and what the numbers look like, what are the pros and the cons? Okay, so first let's talk about the pros. So as with the example we just looked at, you're potentially left with little to no money out of pocket after the refinance closes. And obviously, the better deal you get on the purchase price, the more undervalued you buy that property, and the better your ARV, so the more equity you add to the property with your rehab, the better the deal and the less cash out of pocket that you're going to have. The second pro is your cash on cash return. It's a high return on investment. So you've paid little to no cash out of pocket, but you've now got this monthly cash flow. So that's a really good cash on cash return. The third pro is the equity that you now have in the property. So you've built equity by purchasing the distressed property and rehabbing it, and now you've left all this equity in the property after you do your refinance. So in this example we just looked at, you've $87,500 worth of equity in the property when you're done with it all. Another pro of the BRRRR strategy is it's possible to get higher rents for a recently renovated property. So you might have renovated this property to a Class A or maybe a Class B property, which gets you higher rents, which means higher cash flow than if you had just bought a turnkey Class C property that maybe needed a little bit of cosmetic work, but you didn't do any rehab because it was ready to go. And the last pro, and probably the most important one, is the scalability factor. So you didn't need much cash to do this property. So you can move on to the next one and the next one. So it means you can grow your portfolio much faster. Okay, so we've talked about the pros, so what about the cons? What are the things that you need to watch out for? Well, number one is your rehab could go over budget, which can happen to any investor. So it's really important to have your numbers nailed down at the start, so you're going into the project really knowing where your numbers are, and also set aside a contingency in case your rehab does go over a bit. The second thing to watch out for is time delays. So obviously if your project goes on longer than expected, not only if you took out a loan is it costing you more in carrying costs because you're paying more months of interest than you thought you might, but if you got a hard money loan, then you're at risk of potentially the term of that loan expiring and your note being called due. Something else that you need to be aware of is seasoning. Okay, so different lenders have different rules for how long you need to have owned a property before you can do a refinance on it. So if you're not working with the right lenders, then you may have to wait a while before you can refinance it, which means obviously extra carrying costs. So more months of interest, more utilities, etc. And then of course, which is happening quite a bit at the moment because of the market that we're currently in, is low appraisals. So when you do that refinance, if that appraisal comes in lower than you expected, than you estimated your ARV to be, then obviously that's going to affect your refinance loan. It might mean that you get less cash back into your pocket, or if it's really bad, if the appraisal really isn't where you thought, maybe you have to actually pay money out of your pocket to do the refinance in the first place. So as you can see, the BRRRR strategy can be a really clever way to grow your real estate portfolio with little to no cash out of pocket. But there are pitfalls, and it's really important for both investors and loan brokers in this space to know what those pitfalls are. So that's it on the BRRRR strategy, and if you liked the video, please do give it a like and hit the subscribe button. So every week we do post content on DSCR loans, hard money loans, and loan brokering. And if a career as an investment real estate loan broker is something that you feel might be a good fit for you, in the description below we'll put a link to a free workshop that we have on DSCR loans, hard money loans, brokering the loans, all that you need to know. It's really your first step on your journey to becoming a loan broker in the investment real estate space. And that's brought to you by the Loan Broker Academy. And I'll see you next time.